Good morning to you all, crypto ambassadors across the globe. Yes, we are starting the meeting very soon. So, please, I urge you share the Zoom link or the meeting link with your friends, your downlines, especially your team members, so that they can join for us to start. Okay. So please share the link. Share the link. There are some of the team members that they need this meeting very well. So don't join the meeting without them. Mm, Don't join the meeting without them. So please share the link. Okay, so that we can all start. Okay, so whilst you are waiting for them to join us, maybe let's hit about 60 members, then we start. So whilst you are waiting for them, I would like for you to introduce yourself. To tell me your name and where you are joining the meeting from. Okay, to tell me your name and where you are joining the meeting from. So whilst we are waiting for them, let's do this briefly introduction. Whilst you are waiting for them to join us, tell me your name and where you are joining the meeting from. Okay, so we have Lydios from Uganda, with Sam from Uganda. Okay. So Jane Paul from Rwanda. Abel from Tanzania. Maya from Johannesburg. And Richard from Uganda. Okay, so we have Afieni from Dubai. Sanju from Germany, my leader. Alright, so Richard from Uganda. Wow. That's very nice. That is very nice. So share the link, share the link so that we can join. Okay, so we have Elijah from Dubai, from Uganda, Vincent from Uganda. Okay, so Nicholas from Uganda, Robert from where? Okay, Rwanda. Okay, so they didn't mention his name, but he says he's from India. And then also we have Zipel Pale from South Africa. Sorry, I may not be able to pronounce all the names right. Okay, so forgive me for that. Okay, so share the link so that I can join. So we have Susa from Uganda. So far we're having all the Ugandans here. That is nice. How about the Kenyans and then the Ghanaians? Where are they? So this one too is from Kenya, and then Katrina from Uganda. Sorry, from Uganda, and then Melo from Uganda. Then this one too is from Nigeria. Okay, from Nigeria. Good. That is good. Okay. So Camilla from Uganda. This one too is from Uganda. Lesotho. Okay, that is good. From Nigeria. Joram from Uganda. So Ghanaians are here. And we are not seeing you, eh? Okay, so I think please we should share the link. Okay, share the link for your team members to join. I've always been saying that if you are building a business, what it has to do with teamwork. If you join a business or training without your team members, there is a saying that if you are building business that is supposed to be with your team members and you are building it alone, you are only building a disaster. If you want your business to grow, the easiest way your business can grow very fast is by building it with your downlines. That is, when you are supposed to go to meeting or any training, don't go alone. Don't go alone. Ensure that whatever you learn, your downline also learn it. So if you are there, share the link with your downlines. Let them also join. Share the link with your team members. Let them also join to learn. That will be the easiest way you can grow, right? That will be the easiest way you can grow. So if you really want to grow in this business, the easiest way to grow in this business is ensuring that anytime you join every meeting, you join with your team members. Do you get it? Sure. So please share it with your team members, your downlines, let them join so that we can start. Right? Okay, so I think we are 67 now, 69 here, and nothing prevents us from not starting. Hmm? Nothing prevents us from not starting this morning session. Okay? Nothing prevents us from not starting this morning. Okay, so I think with the introduction, we will end here. Another time we continue. So my dear is from, she says she's from where? Ethiopia. Okay, I am. The sailor from where? From Ethiopia, and then this one too from Kenya in the house. Good. So good morning, guys. All right. So that is fine. Let's start. Let's start. Okay, so quickly let me share my screen. But before I share my screen, remember we are discussing about the futures trading, how to trade on the futures market, how to trade on the futures market. And over time, we've taken time to discuss a lot about the futures market, how to trade on the futures market, how to set up a trade on the futures market. We've also discussed about the breakdown key concepts on certain terms that you can see them in futures trading, like position size, your leverage, how to even do the calculations for your leverage, and then also your liquidation price. We've discussed a lot of terms. So this morning we are going to go over again. We're going to discuss an interest. We are going to have an interesting discussion. Some terms that we will be familiar with them in the futures market for us to digest them together. Okay. So kindly follow this meeting and let's enjoy everything together. Okay. Let me share my screen. Let me share my screen. Okay, so I'm sure my screen has been shared now. You can see my screen. Can you see my screen now? Hope my screen is visible. Can you see my screen now? Can you see my screen now?
Yeah, Leader Emmanuel, we can see your screen. Please continue.
All right. All right. Okay. Then let's proceed. So, okay. Obviously my body is dirty because I've been teaching most often. So, or always. So, realize that always my body is fine. So, let's start. Now, trading on the futures market, like I've been saying all the time, is very simple. Fortunate for us, Royal Q has presented two forms of trading for us. We trade on the spot market and on the futures market. We trade on the spot market and on the futures market. We've taken time to explain over time different strategies, different techniques on trading on the spot market, on trading on the spot market. and we've explained what the spot market means to every individual, every single trader, and thousands of traders are making profit on on the spot market every single day. So I know almost about 99.99999% of as that we trade. We are so abreast with the spot market. We understand the concept of trading on the spot market. We understand the risks on the spot market. We understand the profitability rate on the spot market. We understand all the corners of making money on the spot market. Now, we've also come to learn about the futures market. You've also come to learn about the futures market. Some of you are already trading on the futures market. You've seen how the futures market works. Now, when we talk of the futures market is a market different from the spot market. The futures market is different from the what? From the spot market. So before I proceed, what we are going to focus on this morning, you may see some terms like position size. So take notice of them. You can write them down. Position size. You may see new terms. Maybe it may be new, it may be old, like cross margin. Okay, like hedge. Okay, then um liquidation price, that is LP. There are many. So these are some of the terms that you may see through our discussions this morning. And then average price. So please pay attention. That is going to be the basis of our discussion this morning. So pay attention. Okay, good. So when it comes to trading on the futures market, unlike the spot market where the trader trades and owns the assets, what makes the trading on the futures market to be different from trading on the spot market is that now trading on the futures market, we said it's a contract market. The futures market is a contract market, and the reason why we are saying that the futures market is a contract market is that unlike the spot market, which has to do with ownership of an asset, so whoever trades on the spot market owns the assets. You bought money with the asset, and that is the reason why anytime the asset drops, the value or anytime the value of the asset drops, your money drops in value. If it's rise, your money also rises in value. And the interesting thing is that on the spot market, we've consistently said that there are no losses on the spot market because equity of an asset or equity can never get to zero. Okay, equity can never get to zero. That is the reason why on the spot market, consistently, we keep preaching that there are no losses on the spot market. Notwithstanding, when you come to the futures market is not the same as what at the spot market. So the futures market is a contract market. The futures market is what? It's a contract market based on leverage. Based on leverage. This is the main reason why the futures market is different from the spot market. So the futures market was made so that every single trader can profit or can make take opportunities in the market with little amount of money and yet make more money. With little amount of money and yet do what? Make more money. Now, a normal circumstance, anything that has to do with leverage, it simply means it's about less effort, more results. Less effort, more result. Anything that has to do with leverage. That is the reason why we say that, or there is a saying that if you want to be rich in life, build leverage. If you want to be rich in life, build leverage. If you want to create wealth, build leverage. Because leverage is the only way you can reduce your efforts and yet increase your results. Leverage is the only way you can reduce your efforts and yet increase your what? Your result. So anything that has to do with leverage communication, it simply means less efforts, more results. Less efforts, more results. So in the case of trading on the futures market, we said anytime the trader is using a leverage, or since the futures market has to do with leveraging, it simply means the trader can use small amount of money to trade on the futures market. Yet, because of the leverage, increases his position size, increases his what? His position size. So, assuming the trader is trading with, let's say, $10, and then he chooses to go for a leverage of 10x. This is called leverage, a multiple of your actual value, a multiple of 10. That is a multiple of your actual value. So we have 1x to some exchanges provide up to 100x, 250x. So over here, we are going to use 20x as our highest leverage, 20 or 20x. So assuming, so this is leverage. This is what we mean by leverage. So any amount of money that you have in your account, if you go for 20x leverage, or if you go for 10x leverage, this is what it means. So you go for 10x leverage. Now, once you go for 10x leverage, it simply means 10 times 10, which is 100. Okay, so it simply means the trader is having a real money of $10, but leveraging it with what? With $100. Leveraging it with what? With $100. So in this case, you have your real money is $10, and your leverage position amount is what? Is $100. So in the case of you trading, now you've created two things here. You've created two things. You've created what you call position size or position amount. Eh? And then also margin. You've created two things here: position amount and then margin. So you've started. The terms are now beginning to do what? Um, you're beginning to apply the terms. So please now follow attentively. Follow attentively. So now the amount that is based on the leverage is your position amount, and then the 10 becomes your margin. Okay, the 10 becomes your what? Your margin. Pay attention to this. So in the case of you trading, we said the profits you are going to make in the market is not based on your margin, but it's based on your position size. Okay, it's based on your position size. So let's assume if I'm able to make if the market rise plus, I will make profit based on this position amount, which is 100. Okay, so plus one of this is going to be what? Is going to be let's assume that is going to be one. Okay, that is $1, which is 10%. 10%, and that is 10% of my initial cap, which is $10. Okay, my margin amount, which is what? Which is $10. So in the case of you trading, you can realize that you use under normal circumstance you wouldn't be able to make sharp money on what? On this $10. But because of the leverage amount, because of the leverage, now you've been able to raise or make sharp profits using your little amount of, or your small amount of money, using your small amount of what? Amount of money. So with your position size and then your margin, you'll be able to do it, trade on the futures market. Now in the same manner, because you're also making profits, when the market also goes against you minus, now the same way that you are making profits, the asset too will be dropping, or you're also losing. Now in the case of you lose, we call it liquidation. Okay, liquidation. So in this case, anytime this market goes against you, it's also happening that it's affecting this money, the money here. Why is it affecting? Because it is a contract market based on two conditions. It is a contract market. Now first, based on your leverage, and then based on another term called your direction. on your direction. Now, am I running with the lesson? 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 Okay, so am I running with the lesson? Please, if I'm running very fast, let me know. If I'm running very fast, let me know. If it's okay to let me know. Okay, someone is saying yes. Someone is saying yes. Am I running fast with the lesson? Am I running fast with the lesson? Oh, okay. Oh, someone too is saying no. Am I running fast with the lesson? Okay. Let me take time. Okay. Let me take time. Let me drink water, swallow, and then my driver, and then take time. Okay. Okay. All right. All right. So I'm taking time. Okay. Very good. Now let's get back to the board and follow. So we said now the reason why it's supposed to happen so you are on two conditions of the market. One is your leverage. You've assigned for a leverage in the market. The second thing is that you are also opting for a direction in the trade. A direction. So this means you've gone for a leverage to win the market on a particular direction. On the direction, it's either you are on long or short. It's either you are on long or you are on what? On short position or direction. Now, the long simply means that anytime we talk about long in the futures market, it simply means the trader is predicting the price of the assets to rise. It simply means the trader is predicting the price of the assets to rise. And anytime you see short, it simply means the trader is predicting the price of the assets to fall, right? So you see long and short. So in the case of trading on the futures market, if you go on long, means you believe you've predicted that the price of the asset, being it Solana, being it SRP, being it BTC or whatever it may be, you've predicted the rise of the assets. So now, when you predict that the asset is going to rise, and it's happened that it's rise, so let's assume the price of the asset is $1, and you predicted long. Okay, you've predicted what? Long. It simply means you are predicting the price to move from $1 plus. So either from $1 to 1.1 or 1.2 or $1.5 or to 1 or even $2. So anyhow, you are expecting that this price should move. You've longed it. Now, if it happens that this asset that is supposed to move from $1 to positive results couldn't move from $1 to to any positive results, and it's rather reversed to negative. So minus 2, it's rather dropped from $1 to, let's say, 0.5. In this case, we says that the market is what is going against you. In same manner too, in the same manner, if let's say this price is $1, the asset is $1, and you've seen that okay, the price of the asset, this $1, would surely drop from $1 to 0.5. So in the case that is going to drop, your expectation is to short the market. This means the more this $1 drops, the more this asset drops in value, the more it drops from $1 to from $1 to 0.9, 0.7, 0.6, 0.5. That is where you can make your profit. So if this asset couldn't drop from $1 to 0.9, but rather it increases from $1 to 1.5, 1.2, 1.3. It simply means the market is what is going against you. Now we all know that Anytime you set up a trade or anytime you make a prediction, the market can easily go against you before it reverses back in your favor. So it is not always automatic. It's not what automatic trading is not automatic zone where you set up a trade, you predict, you get a coin. Once you set it up, and it's sold. No, definitely it's because the market is not in does not move in one direction. It's an up and downward market, up and down market. So before the condition will be met or will be triggered in the market must first do what go against you first before it will go in your favor. That is the idea of trading because we said assets are volatile. Now that's just by the way. So now what we are saying is that you either go on long on the futures market or you go on short. And your reason for going on long and short is because you either believe the asset is going to rise or it's going to do what? It's going to drop. In the case that the asset that you've predicted that it's going to rise, so you've gone on long, wouldn't rise, we say that the market is going against you. And if it goes against you to a certain extent, you get what we call liquidation. If it goes against you to certain extent where your margin amount is finished in the market, that's what we call what liquidation. Now before liquidation will happen, so I've introduced another term. When we talk of liquidation is the state at which your margin amount has been equal to your liquidation price. Okay, so the margin amount that you've used to set up the trade is finished out of the market. So another term too that we can use for your liquidation or liquidation is what? It's collateral. Collateral amount. Another term for liquidation is what? It's collateral amount. Liquidation amount is also what? Collateral amount. Or anyway, so let's use the word collateral amount. So your collateral, okay, the money that you've used to do what? To bargain the market. That is the idea. So in the case of trading on the futures market, I've always been saying that the futures market works like just the banks. Okay. How the banks loan individual. Now, before they will loan you money, you must have some money at the bank, you must have saved some money at the bank, or you have a property that you can use as collateral. Why are they asking for collateral? Because you could fail the contracts. There will be a breach of what contract. You could fail the contracts. So in a case where you fail the contracts, you have to use the collateral. They would have to use the collateral amount to pay for the debt, to settle the debt. So since you are also trading on the futures market, the margin amount, remember you based on the margin amount to go for a leverage. Now you cannot win the trade. Since you cannot win the trade or the exchange must use that money as a form of what collateral to settle their um amount that you borrowed to trade. That is the meaning of that is when we say that the person has been liquidated. So the word liquidation, that is what it means. So at the point that you seems liquidated, it doesn't mean any too strange. It simply means they have taken the money because it belongs to them. You couldn't win the what? The contract. Now, before liquidation will happen, so we are gradually moving. Before liquidation will happen, there is what we call liquidation price. Liquidation price. So, like I said, we are going to have more discussion on some of these terms today. So, pay attention and then do what follow. Liquidation price. Now, when we talk of liquidation price, listen to this. When we talk of liquidation price is the target price at which the exchange has given based on calculation that once the price of the asset you are trading drops to this volume or drops to this amount, you need to be out of the what? Out of the market. So let's assume you are trading on a particular asset. Let's assume Solana. That is the price of Solana is 180. Okay. Now the exchange I'm giving, or based on calculation, your liquidation price, that is LP, your LP is what? Is, let's say, $80. Is $80. This means, so far as this asset, let's assume you are on long, okay? You are on long. Let's assume you are on long, and the price of the asset is what? Is 180. So you are on long. Now, so far as you are on long, if Solana rise from 180 to one to another to a positive value, you'll be in profit. If Solana drops to, you are also running. The market is going against you, right? In this case, what we are saying is that you have what we call liquidation price, which is 180. Which is 80. Please, I'm not saying it is fixed. We are making an assumption, which is your $80. Now, this means when Solana drops from 180 to $80, you will be terminated out of the market, or you will be liquidated. You will be liquidated. That is what it means. So until this asset drops to 180, you will still exist in the market. You will still be in the market. Now, that is the idea of what? Of liquidation price. So far as this asset hasn't dropped from 180 to $80, you will continue to be in the market despite you are not making profits. You will still be in this market. You are not losing the money to. You will still be in this market until the asset reverses back and then, or rise back for you to do what? Make your profit or hit your target. Are we learning? 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 Very good. Very good. Very, very good. All right. Now we can proceed. Now we can proceed. Now we can proceed. Now, when it comes to trade on the futures market, now you've seen liquidation price. We'll get back to the liquidation price. We will expand it because today our conversation is going to revolve around the liquidation price. You need to get it very well. When it comes to trading on the sports market, on the futures market, what makes people interested in using Royal Kill are these things that we're discussing. Okay, are these things that we are discussing. And the first thing that you would hear, you need to be familiar with it, is cross margin. Cross margin. Let me use the word for that. Cross margin. Then the next one is what? Margin calls. Margin calls. And then the last one is hedge. Hedging. Hedging. So I'm going to take time to explain what we mean by cross margin and how cross margin works. Then take time to explain how margin calls works in using Royal Killbot to trade on the futures market. Then also explain hedging, how hedging also works. So first, bring us back to our liquidation price. So pay attention. The liquidation price is important, and you need to understand it more. So pay attention to this. Now, in trading on the futures market, there are two forms of margin. There are two forms of margin. One is isolated margin, and then the next one is cross margin. So in royalty, we use this cross margin, but let me briefly explain the isolated margin. When we talk of isolated margin, let's assume I have $100. Okay, I have $100. I use all the $100 to trade. Now the market is against me. If I'm to be liquidated, now since I've used all the $100 will be out of the market. So far as the market goes against me bitterly for me to be liquidated, I'm losing all the $100. That is the meaning of the isolated. So with the isolated, it's only focused on the money you've dedicated to the market. It's focused on the money you've dedicated to the market. If it is $1, you can't add any amount to the $1. If it is $5, you can't add any amount to the $5. Do you get it? That is the meaning of isolated margin. So if let's say you have $10 that you are using to trade, you've exposed that $10 to the market. You can't expose more than $10 to this market. You can't expose more than $10. So you can only use $10 to trade. You can't expose any amount of money aside this $10. That is the meaning of the isolated margin. So once this $10 is in profits, you come out of the market. If the market is also going against you on this $10, you get liquidated, then go your way. That is the meaning of what the isolated margin. But when it comes to cross margin, Royal Q uses cross margin. In Royal Q, we uses cross margin. Now, what is the meaning of the cross margin? With the cross margin, with the cross margin, let's assume I have $100, the same amount. I want to expose $10 to the market. Now, the market is going against my trade. Okay, the market is going against my trade. Since I have $100, the market will go in addition and then use part of this remaining $90 to add up to this $10, so that it can continue the contract or the trade. In order not for me to lose the $10, it will add up, because the reason why we get liquidated, or the reason why liquidation happens in the futures market, is as a result of low capital to continue the contract, right? Or less capital to continue the contract. So since you have some money here, it will come to add up to the $10. Take part of this money to add it up to continue the trading. So this is where margin calls are important. This means if you have a trade, your position set on what? On cross margin. Anytime cross margin is involved, you have the opportunity to open margin calls. Margin calls. You have the opportunity to open margin call. And mind you, a trade without a margin calls is like a car without a brake. A trade without a margin calls is like a car without a brake. A trade without a margin calls is like a car without what? A brake. That is the reason why we uses the cross margin. That is the reason why we uses, or the Royal Q both gives the trader opportunity to use cross margin. So now you've understood why it is important to use cross margin compared to isolated margin. If you understand, give me one in the chat. If you understand, give me one in the chat. If you understand, give me one in the chat. If you understand, give me one in the chat. If you understand, give me one in the chat. If you understand, give me one in the chat. If you understand, give me one in the chat. Very good. Very good. Now we can proceed. Now we can proceed. Good. So now you've understood cross margin. You know it is important for you to set your trade or your setup, have your setup on what? On cross margin, and no longer what? Isolated margin. No longer isolated margin. Right? Good. No longer isolated margin. Now the next thing that I'll talk about is margin calls, but let me hold on. And then after that, Royal Q also gives the trader the opportunity to use what we call hedge mode or hedging. Hedge. Now there are two forms of mode on in futures trading. The first one is one-way mode. One-way mode. Then the second one is hedge mode. Hedge mode. Now when we talk of one-way mode, when we talk of one mode, let me use this opportunity to explain the one-way mode to you. When we talk of one-way, the trader you set up a trade, let's assume Solana. Now, you predicted Solana to rise. Solana is dropping in value. That is, it is on short. So on long, Solana 2 is on short. It's either you close the trade or you wait for possible price reversal. It's either you close the trade or you wait for price reversal. If not, you liquidation will hit you. Do you get it? That is one way mode. So on one way mode, since you are on long, you can't go on short again. Since you are on long, you can't go on short. That is the one way mode. So you open up a trade, the market goes against you, you close the trade or you get liquidated. It's simple as that. Or you wait for price reversal. Since price reversal may not work, or if price reversal couldn't work, all what you have it's has to happen to you is to what to be liquidated. Now that is for one way mode. When it comes to hedge mode doesn't work like how one way mode works. It's different. Hedge mode, assuming you are on long on the market is going against you. You can take advantage and go on short on the same trade to make profits. You can take advantage and go on short on the same asset to make profits. You can take advantage over the market to go short to do or to make profit. So before this asset will rise to long, you've made even the profit you are expecting to make in the market. You've made profits on short. And sometimes it's so interesting that sometimes you realize because the market may take time before it rises back to long position, you make profits and even make the capital you've used to set up the trade on the long market. Do you get it? So when you have long, you can still open short. That is the meaning of hedge mode. That is the meaning of hedging in the futures market. So mostly big boys or big traders uses the strategy called hedge. That is the reason why Royal Kill says that okay, it is important for you to be a trader. And if you want to be a trader, then you need the best trading strategies. You need the best trading strategies to trade and then also make profits. So I've always been saying that especially when it comes to the hedge mode, the main purpose of the hedge mode is what? It's flexibility. You need to have a flexible trading, flexibility, and then also what? Profitability. That is it. Flexibility and profitability. That is the reason why hedge mode works in Royal Kill. So Royal Kill loves you and they always want to give you the best strategies. Royal Kill loves you and they always want to give you the best strategies. Okay, now back to the next one. Now you've understood cross, you've understood hedge, you've understood cross, you've understood hedge. If you understand, give me one in the chat. If you understand, give me someone saying, can you repeat, my leader? Okay. If you understood what we are discussing, give me one in the chat. If you understand what we are saying, give me one in the chat. If you've understood, give me one in the chat. All right. Now we can proceed. Okay. So back before I proceed with the next. Now we said when we talk of hedge, okay, we have one way mode and then hedge mode. One way mode. One way and then also mode. Hedge mode. We said with the one way mode, if you have a trade, okay, if you open up a trade, we know that we've discussed about direction here just now. We've discussed about direction not long ago. So if you have a trade, you either go on long or short. So if you have one way mode set up, the only thing you can do is that anytime the market goes against you, let's assume you are on long. If the market is going against you, you either have to wait for price reversal. You either have to do what have to wait for price reversal or close the trade. If you can't wait for price reversal, you need to close the trade or expect liquidation. But in the case of hedge mode, in the case of hedge, pay attention and listen to this. In the case of hedging the trade, now the trader would be able to open another position aside the long. You'll be able to open another position on short on the same asset. So if it's Solana, you can open long and short simultaneously. You can open long and short simultaneously. That is what we mean by the hedging. So you can open long and short at the same what? At the same time. Now, aside that, we also said when it comes to the setup, we uses the cross margin. With the cross margin, this is what we mean. We said the cross margin gives the trader the opportunity to open margin calls because when you set up a trade or when you set your trading on cross margin, let's assume you have $100. You use $10 to trade. When the market is going against you, now because you have $90 remaining in your futures account, it will add up. Part of this $90 will be added up to your what? Your $10. So let's say making $20 in order to continue your trade for you. But unlike isolated margin, if this might you have money to trade, but because you set up your trading or your strategy on what? On isolated margin, you can only use the $10. You can't use all the 90, you can't use the $90 in addition to the $10. So we said Royal Q give the trader opportunity to use what? To use cross margin. Now, the advantage of cross margin is to help the trader open margin calls. The advantage of the cross margin is to enable or help the trader open margin calls. So, this is where we are going to continue with the discussion. Now, listen, margin calls. Margin calls are important in trading, and we know that. There is no doubt about that. But there are certain unique things about margin calls when it comes to trading on the futures market. There are certain unique features on using opening margin calls when it comes to trading on the futures market. Now, on the futures market, ideally we know that when you open margin calls, let me test you small before I proceed. Now, what is the benefit of opening margin calls? Write your answer in the chat box. What are the benefits of opening margin calls in trading? There are some of you enter the trade, you don't open margin call, then you join the market. I'm in floating loss. I'm in floating loss. Meanwhile, you didn't open margin calls. Hmm? You didn't open margin calls. So now, what are the benefits of opening margin calls? What are the benefits of opening margin calls? What are the benefits of opening margin calls? So to control the flow of capital in the markets, very good. To avoid loss, to extend your liquidation price, to control losses, to avoid nice. Okay, you have a very fair. So guys, margin call. I said when you set up it's just like a car without a brake. Do you get it? Like a car without what? A brake. A car without what? A brake. That is what you need to know. That is what you need to do. What you need to know. Now, margin calls. The main purpose of opening margin calls, especially when it comes to the is to be creating what? Margin calls help the trader to create new average prices. So you create new average what? Average price. When you open margin calls, you create new average price. Now we are gradually going. Okay, you create new average price. Average price. Now, anytime a trader creates new average price in the futures market, it helps him to also increases or create new liquidation price. Liquidation price. So we discussed about the liquidation price and we are going to expand it. This is the main reason why you need to open margin calls in your trading. This is the main reason why you need to do what? Open margin calls in your trading. So when you talk of an average price, what is an average price in the first place? What is an average price? Now, when you talk of an average price, An average price is the price, the original price at which you bought your assets, or the value at which you bought your what, your assets. So let me give you an illustration here. Let me give you an illustration to why average margin calls are important in creating new average price and then what, liquidation price. Let me give you an illustration here. Let me give you an illustration here. So now let's assume your capital is $100, or let me use, okay, $100. Okay, your capital is $100. You are trading on Solana. Okay, you are trading on what, on Solana. Now the price of Solana is 150. This is an assumption. We are not using the actual price of Solana. So the price of Solana is what, is 150. That is the price of what, of Solana, 150. Okay. Now, because you are going to open margin calls, you are not going to enter your funds or enter into the market with all these $100. So let's assume you are using $20. So let me use this story. Okay. This table here. Now, this is your money is $20. The price is $150. So you bought it at what? 150. And then your liquidation price too is what, is, let's assume, um let's use 60 as your liquidation price. So 60 is your liquidation price. You bought the assets $20 at a price of $150. Now, anytime you buy again, let's assume now it drops from 150 to, let's say, 130. Maybe you are on long, okay? From 150, it dropped from 150 to what? To 130. Okay? From 150 to 130. You bought another $20. So this, in this case, this becomes your new average price. The 130 becomes your new average price. Now your liquidation price too will change from 70, from 60 to, let's say 50. Okay. So now this becomes your new liquidation price. This becomes your new liquidation price. The 130 becomes your average price, and you bought it at what, $20. Now your capital is $100. You've not finished. The market drops again from 130 to 120. So you bought another $20. After buying another $20, now you've created a new liquidation price, which is from 150 to what, 140. Okay. In this case, follow this lesson. In this case, now, instead of you being liquidated when the price drops to what, to $60, this time round your liquidation price is expected around what, around $40 and no longer $60. Do you understand? Do you understand? If you understand, give me one in the chat. Do you understand? If you understand, give me one in the chat. If you understand, give me one in the chat. If you understand, give me one in the chat box. If you understand, give me one in the chat. If you understand, give me one in the chat. If you understand, give me one in the chat. Okay, so some are saying no. If you understand, give me one in the chat. Let me know if you understand. So, okay, okay. Some are saying no. Now, what we are saying is simple. We are talking about margin calls. We are talking about three things together. Okay, three things at a go now. So now let's go back to the board. Let's go back. Pay attention. Pay attention. Let's get back to the board. Now, this is it. Okay, we said margin calls. And the main reason why a trader needs to create margin calls, the first thing is to create new average price. Margin calls help the trader to create new average price. So over here, this is our average price. Okay, this, the middle one is the average price. Now we said when we talk of an average price, An average price is the original price at which you bought an asset. An average price at which you bought an asset. Now let me ask this question. Let me ask this question. You went to the market, okay? You went to the market. Buy let's assume um okay, what should I use? Tomatoes. Let me use tomatoes. Okay. So you went to the market to buy a box of tomatoes. Listen to this. I'm asking you a question and be ready to give me an answer. You went to the market to buy a box of tomatoes. Now, one box of tomatoes was sold to you at $100. One box of tomatoes was sold to you at $100. And presently, a box of tomatoes is sold at $150. Presently, a box of tomatoes is currently in the market at what, $150. What is the average price of the box of tomato that you bought? You bought it at $100 and it's being sold presently in the market at $150. What is the average price of the tomatoes you bought? What will be the average price of the tomatoes you bought? What will be the average price of the tomatoes you bought? You bought the box of tomatoes at $100 and it's being sold at $150 in the market presently. What will be the average price of the tomatoes you bought? What will be the average price of the tomatoes you bought? What will be the average price of the tomatoes you bought? What will be the average price of the tomatoes? What will be the average price of the tomatoes? Hey, confusion everywhere. Hey, eh? There's something that Julius has been saying that when you join the Zoom meeting, drink water. Eh? Drink water. Drink water before you join the Zoom meeting. I'm seeing different things here. Well, from this confusion, hmm, we are getting mathematics from from different sources. Eh? We are getting mathematicians who are Pythagoras. We are getting mathematicians who are from different sources. Okay, so someone is talking about divide the tomatoes by the amounts. Now, this is simple. First, we are talking about the average price. Now, we said when we talk of the average price in this our discussion, listen, we said when we talk of the average price, anytime you buy the asset, you've created a new average price. You've created a new price there. That is assumed to be your average price at the moment. So there is what we call average price and current price. There is what we call average price and what and current price. Hold on. I'm moving on faster to anything. So the price at which you bought the original price of the assets. Okay, that is going to be the average price in our discussion here. And then it's sold in the market at what? At a different price. So that different price is the current price of the assets. Okay, that different price is the current price of the assets. Please don't let too much mathematics flow in your mind. Listen to what we are saying. That one is called over mathematics. Don't do over mathematics. Take your time. Now, what we are saying is that you join the market or you bought the assets at the price of $100. That one was your average price, your original price. Now, after you bought the asset, the price changed from 100 to what? To 150. If you want your original price as the average price of the assets at which you bought the assets, that is 100 and what? 150, sorry, $100. Mhm. Don't let over mathematics kill you. Okay. So now back to the board. We said anytime you open margin calls, you create a new average price. Anytime you set up a trade or you open margin calls, you create a new average price. And the average price here is the new price at which you are buying the asset. The new price at which you bought the asset becomes your average price. So in this case, what we are saying is that listen, what we are saying is that you have $100. Let me clean the board and go over again. You need to understand this. You need to understand this. This is simple. Okay? This is simple. Now, let's go over again. Don't let over mathematics what kill you. Too much mathematics. Free your mind. Okay? Free your mind. Free your mind. Okay. Now, come here. We said you join a market. Okay? You've joined what? A market with a capital of $100. And you are to enter into the market at different what in different badges. So you are going to buy the assets based on what badges. Now the asset is sold at $150. You are on long. You are on what? On long. Okay. Since you are on long, you expected the price of this asset to rise from 150 to a different value, to rise in value. Now you've joined the market with $20. When you joined the market with $20, you bought the asset at $150 with an average with a liquidation price of what? $60. So now you have three things here. The $20 is the amount you used to buy the assets. The $150 is the average price of the asset. That is the original price at which you bought the assets. And the $60 is the liquidation price. Please listen to this. The $60 is your liquidation price. What we are saying is that anytime you create or you open margin calls, it gives you the opportunity to create a new average price. And anytime you create a new average price, you also create a new liquidation price. Are we learning? Are we learning? Anytime you open margin calls, you create a new average price. And anytime you create a new average price, you also create a new liquidation price. Are we learning? Are we learning? Are we learning? Okay, very good. Now we can proceed. So now you've understood. So now the next thing that you have $100 as your capital. You've used $20 to buy an asset at the price of $50 with a liquidation price of $60. It simply means the liquidation price simply means when this asset you are on long. So if it drops from $150 to $60, you will be liquidated. Right? Very good. So now you bought it has dropped from 150 to 130. So you bought another $20. Now your liquidation price changed from 60 to 50. This is what we are saying. So now the markets would have to focus on the 130 because that is the current that is the original price in the market now. That is the average price. Your average price is now 130, no longer 150. The average price in the market now is what? Is 130 and no longer what? 150. This means if the asset drops to one even $60, you're not going to be liquidated because your liquidation price is now what? $50 and no longer $60. Now you bought another $20 because it drops to $120. Your liquidation price changed from 50 to $40. So we are discussing about the essence of margin calls and the concept of what? Liquidation price. So you always need to create a new average price in order to enjoy or survive in the market with what? With your liquidation price. And it is the liquidation price that maintains you in the market. Do you understand now? Do you understand now? Do you understand now? Do you understand now? Do you understand? Do you understand? If you understand, give me one in the chat. Do you understand? If you understand, give me one in the chat. If you understand, give me one in the chat. If you understand, give me one in the chat. If you understand, give me one in the chat. If you understand, give me one in the chat. If you understand, give me one in the chat. If you understand, give me one in the chat. Very good. Very good. Now you've understood the essence. Good. So profits are made on the what? On the average prices. As usual, we know that. As usual, we know that. Please, liquidation price is not the margin call. Liquidation price is not the margin call. We said the margin calls gives you the opportunity to create new average price. Okay, the margin calls gives you, look at what is written on the board. The margin calls give you the opportunity to create a new average price, and with the help of the average prices, you also create new what liquidation price. You also create new liquidation price. You also create new liquidation price. It's simple as ABC. It's simple as what? As ABC. It's simple as what? ABC. Do you understand? Do you understand? I want to add the last thing to it so that we bring the session to an end. I want to add the last thing to it so that we bring the session to an end. Okay. So, do you understand so far? So, where we've gotten to, do you understand? Do you understand? All right. Then we can proceed. If you understand, we can proceed. So it's the answer is yes, sir. So our profits made on those margin calls, and since from the spot markets, always learn how to transfer knowledge. Okay, on the spot markets, anytime you create average prices, you know that's the reason you said the power of the margin calls, because you make profits. You buy the dip, you make profits on the dip before it's rise. It's the same as margin calls on the futures market. You go long, you go short, you make profits on your margin calls. It's simple as ABC. Hmm? It's simple. Now, there are some instances where you set up a trade. If God permit, that is what you look at tomorrow. Okay. But over here, I'm discussing this with you. If God permit, tomorrow we will set up a trade. How to set up a trade? So we will set it up. Look at the features. This feature that we've discussed this morning. Tomorrow in the evening meeting, we will discuss that. So see the liquidation price. You will see the maintenance ratio and all those things. Now, in some exchanges, you see your liquidation price. I'm adding this part to the session, then we end. You see liquidation price written in your exchange. There are some exchanges too, or sorry, I said there are sometimes you wouldn't see it, not the exchange. Listen to this, not the exchange, but sometimes you will see the liquidation price, sometimes you wouldn't see. And you would love to calculate to know how it works. You will have to calculate to know your liquidation price. So in our previous session, I gave you the value or the formula for calculating for liquidation price. I gave you the formula for calculating for liquidation price. I gave you the formula for calculating for liquidation price. Now we said we said if you want to know the liquidation price of an asset, first you need to check your entry. And last week we looked at all these features. The entry. When we talk of the entry on RoyalQ, the entry price is your average price. In the exchange, we call it entry price. That is the original price you bought the asset. The original price you bought the asset is your entry price. The price at which you entered the asset. The price at which you entered the asset. That is your entry price or the average price. So it's either average price or entry price. So if you want to know your liquidation price, it depends either you are on long or short. If you are on long position, it is your entry price multiplied by bracket 1 plus 1 over your leverage. 1 plus 1 over your leverage. So your leverage either 1x, either 2x, either 5x, either 20x. So your entry amount, the amount at which you enter the market, multiplied by 1 plus 1 over your leverage. That will give you your liquidation value or your liquidation price when you are on long. That will give you your liquidation value when you are on long. In the same manner, In the same manner, when you are on short, and you want to calculate for your liquidation price, when you are on short and you want to calculate for your liquidation price, it is simple. Your entry, okay. Oh, okay. Sorry. So this is rather for short, okay. This is rather for short and then long. So with the long, when you are on long, this is rather long. So pay attention. It's your entry multiplied by what? Your entry multiplied by brackets 1 minus 1 over L, where L is your leverage. Where L is your what? Is your leverage. Because sometimes you wouldn't see the value there. Sometimes you wouldn't see the what? The value. So let me use this. Okay. Sometimes you wouldn't see the value. So take notice of that. So this is for long position, and then this is for short position. Okay. This is for long position, and then this is for short position. So take notice of that. So it is important for you to check or know your liquidation value. If you care to know, it is important for you to do what? Know your liquidation value. Mind you, the futures market is an advanced trading. It's an advanced, so it simply means you are growing in trading. You've understood all the forms of trading, and now you are advancing your knowledge and your experience in the financial markets when it comes to crypto markets. So RoyalQ is giving you all these opportunities for free, right? So that is the meaning of the liquidation price, either on long or on short. So if you are on long, it is entry multiplied by bracket 1 minus 1 over L, where L is your leverage. Where L is your leverage. And when you're on short position, it is your entry multiplied by 1 plus 1 over what? Over L, where L is your leverage. Where L is your leverage. Now, if you question to ask from what we've discussed so far. Okay, so please, can we get all the records from the training on futures trading? Yes, so go to YouTube. When you go there, you see. So please, if you have any question, since my battery is running down, so if you have any question, please ask. Please, can we get all the records? So yeah, that's what we said. Yes. So don't get liquidated by network. I think your battery gets. Oh, okay. Yeah. My battery is running down. So okay, so please, if you have any question, kindly ask. Okay. So, you've been asked to unmute. Please, you've been asked to unmute. So, ask your question.
Leader Emmanuel, good morning.
Good morning.
I would like to know why last time I set my trades, and unfortunately, the profits that was delivered, I have set the leverage at 20, but the profits that was delivered, it was as if it was in short. I don't know why it didn't bring in my leverage amount. Yet I had set the 20 average leverage, but it came in as if I had set it with one time.
Which exchange are you using?
Binance.
Oh, okay. Then, sometimes when you set up the leverage, you have to check it well because it can change. If you don't check it, it can change. So if you set up the leverage, confirm before you save the trade. Confirm that your leverage is equivalent to the setup, the leverage entry that you entered there. If it is 1x, check. If it is 2x, check.
But the leverage
Confirm.
was leader.
Pardon?
The leverage was reflecting both on Binance and even in RoyalQ.
So what happened? But you are saying you set up the leverage and it couldn't reflect, or if I didn't get you
It
right.
reflected, but the profits that was given out wasn't of that leverage.
It seems I'm not getting you right. I'm not getting you right. Okay, so if I only get you clear, you open the leverage and the approach they gave you is not working right or something like that, or how?
When I set the trade,
Mm-hmm.
I opened the leverage at 20 times.
Mm-hmm.
And the coin sold, but the profits was like as if I had set it in, as if I had set a leverage of 1 times.
Oh, I get you now. Now, the profit you make is not based on the leverage. Listen, the profit you make is based on your take profit. Okay, if you set 2%, you make profits on 2%, not the leverage that you've selected. The profit will be based on the take profit you've set. Do you get me? The profit will be based on the will be based on the take profits, but not the leverage.
Okay.
All right. So the next person, my battery will go off. Sorry for that. Okay. So please ask your question. Ask your question. The next person, you've been asked on mute to ask your question.
Hello. Hello.
Yeah, we are listening to you. Ask your question.
My question is you mean in the calculations of the long and the short, long means you have to use negative to do the calculation, and then the shorts you have to use the positive. Hello, do you get me? Hello. Get back.
I think his phone is off. I'm
The
sure.
phone is off. No worries.
Leader Emmanuel, are you with us?
No, his phone is off. I can see
Yeah. All right. So I think his phone is off. So we make it tomorrow. Okay. We're going to continue tomorrow. Thank you all for joining in. And you could ask your question the next meeting. Thank you. And I'm going to end this meeting. Bye.
Bye.